Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Goose, and on today's show, we had a regular, semi-regular, he's kind of regular. He's been on the show before. His name is Chris Raymond from Unconditional Finance, and we talked about something that is a very hot topic at the moment. We talk about property finance strategies for high interest rate environments, because that is currently the environment we're in. It is currently a higher interest rate environment, and a lot of people are having issues with getting finance and how to navigate that and need some ideas and tips. We talked about lots and lots and lots of stuff. This is probably kind of a little bit of a long episode. We could have just kept going. There was so much good stuff in this episode that we talked about. We talked about things like how much does interest rate rises actually affect borrowing capacity. We talked about strategies people can use to avoid hitting their borrowing capacity limits as rates go up. We talked about should you be fixing rates, keeping them variable, interest only versus P&I, LVRs. We talked about what is actually happening in terms of valuation. So much stuff. Like if you want to really understand how to navigate property finance in the current environment, a high interest rate environment, then this is absolutely the episode for you. It was really good. It was really high value. You know, I've said this before. Like, I know that when we've hit a nail on the head, and I think this is a great episode that a lot of people are going to get a lot of benefit from, and it's a very timely episode. So I'm super excited for you guys to dig into it. But before we get into the episode, I want to let you know about something that we have just launched. So over the last couple of years, we've been developing a tool. We call it a Property Portfolio Growth Plan. Now, this is an actual tool that actually helps us to map your portfolio in such a way that it is going to meet your goals. So we take on board any existing properties that you might have, and then go, okay, what else do we need to add to your portfolio to make sure that you can hit your goals in the amount of time that you want to hit them? Or in fact, if you have no properties and you're like, I want to get started, but I want to know what the pathway looks like, how many properties, in what order, what to buy, when to buy, and why, to get to my goals in the time that I want to get to them. We've actually built a tool and a service to specifically do that. So we call this our Property Portfolio Growth Plan. And I'm really excited to be able to share that with you. Now, if you want to be able to tap into that, if you want to be able to speak to the team about that, just head to dashdot.com.au, check out our services page. You'll be able to find a link there. You'll be able to book in a call with the team. It's a 30-minute call, and you'll be able to speak to someone about getting your own personalized, custom portfolio growth plan designed specifically around you and your goals. So just again, if you want to get that, head to dashdot.com.au, book in a call. It's super awesome. I personally get really excited every single time I see the plans. They're just great. And it's been really transformative for so many of our clients. And I'm looking forward to that being the case for you too. Now, one last thing, I would really love it as a personal request if you could like, rate, review, and share this podcast. If this is valuable to you, which I'm certain it will be because there's so much good content in this episode, make sure you share this with somebody else, because I'm sure that you know somebody who's interested in property investing, and I'm sure that you know somebody who is thinking about how do they navigate finance in this current environment. So share this episode with them. Without any further ado, let's get stuck right into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me on today's show is Chris Raymond from Unconditional Finance. He's been on the show multiple times. So if you are a regular listener to the Investor Lab, Chris will be a familiar face. But Chris, for those of the people who have only just started listening to the Investor Lab, who this might be their very first episode, why don't you give us a little bit of a background, tell us a little bit about who you are, what is Unconditional Finance, why are you here, what's your expertise? Give us a little bit of an intro.
Beautiful. Good morning, Goose. I guess for the listeners today, Unconditional Finance, we're based in Sydney, mortgage broking company. Predominantly, we work with investors. We do all facets of finance, but yeah, investment property finance is really our niche, our passion. I'm an investor myself. I've got a multi-property portfolio. A lot of your listeners know that. My team are brokers. Most of them are investors as well. So, we service clients all over Australia. Been in operation around 4 or 5 years. I've been in finance, always working with brokers and in that sort of investment property space for around 20 years now. So, yeah, I appreciate you having me on board this morning.
No worries. Well, what we're going to be talking about today is finance strategies for high interest rate environments. That's basically the thesis for today's episode. And I want to just kind of point something out here before we get started. When interest rates started going up, and you and I have talked about it a lot. And I think if people go back a few episodes and listen to some of our forecasts a few episodes back, we were clearly wrong, right? So interest rates are
Guilty.
Yeah. Straight up, all good. Interest rates have risen far more than most people expected, and it's very interesting because, there's a lot of people that I, say follow on Twitter, people like Cameron Cusher, like there's some people, some big names that are all basically putting their hands up and saying, well, We all got that wrong. Interest rates have gone up far further than really anyone expected them to go up. Now, the other thing that I want to point out, and where I made a mistake, is I spent a lot of time focusing on how interest rate rises affect the property market. And I've got some very robust opinions on that, which I'm absolutely committed to standing by because they are absolutely true. What I didn't pay enough attention to was how interest rate rises affect the credit cycle and how that inversely affects investors. And one of the biggest problems that we've seen lately, particularly with our clients, is they'll get a pre-approval and then they'll go to buy a property, and in between getting the pre-approval before they start their property investing journey, and then when they get to get to conditional under contract, their borrowing capacities change so much that they might not even be able to buy a property anymore. And so this is significant. And and people might say, well, Goose, you're an idiot. Why didn't you think of that? Of course you should have been thinking of that. But to be honest, I was so busy proving the thesis around the fact that the property market itself is going to be fine, which it is. And, the people who are buying properties are absolutely crushing it right now. So there's no debate there in my mind. But the access to credit thing, this is huge. And
it is.
Yeah, what have you seen like over these last few months? As interest rates have been going up, tell me what the finance landscape looks like from your side. How has this been affecting investors?
Yeah, good, very good point. Obviously, topic of conversation. As you mentioned before, I think we did our previous podcast around April. I think it was a day before the RBA was due to actually meet. So I guess the listeners online today, I think we're forecasting 25 points. I think it went 50 points. And I thought, the RBA might actually steady for a month or two before increasing interest rates again. So definitely guilty in that sense. Obviously, they've been quite aggressive. The big, buzzword in the room is called inflation. And I guess the RBA and the economy are trying to get inflation under control. But in terms of borrowing capacities, it is a very good point that you're raising. I've done some sort of modeling for a lot of our clients, and on average, most clients have lost around 20 to 25% borrowing power since that April period. So, I guess for the listeners out there today, the cash rate at that particular time for the first rate rise was 0.1%, so 0.10%, and currently we're sitting at 2.6%. And obviously, the RBA is going to meet the first week of November as well, so you can really see how much the cash rate has actually increased. In line with that, the banks have all passed on those RBA increases, pretty much mirroring what the RBA's done. So every time the RBA's increased by 50 points, the banks have passed on 50 points as well. In addition to this, the banks also have a loading on most of their pricing as well. So if you're a client paying 4%, they're stress testing your lending, both new and existing, for the majority of lenders over a 3% margin as well. So in terms of borrowing power, around that 20 to 25% mark. And I've got an example. We'll make it nice and simple this morning, Goose. I've got a client, let's assume he or she is earning $100,000. Very simple, no debts, nothing like that. Prior to these rate rises, that client could borrow around $750,000. So we used to always say,
so that's a 7.5 debt to income ratio.
Correct. Yeah. So around 7.5%. And we used to say that, I think on previous podcasts, we used to say 6 to 8 times sort of annualized income is what the borrowing power is. Now, looking, as of last week, once, most of the banks have passed on that recent 0.25% increase, that same client, that same income, borrowing power now is about 580,000. So it's decreased from around 7,500 or 7.5%, I should say, down to 5.8%. So that's a difference. That's a decrease of around 23% borrowing power. So that same client in March or April this year, in comparison to sort of September, October this year, is being allowed to borrow 23% less.
Have there been any other impacts as well? Because personally, so I got a message from one of our clients last night, and he said, "Hey mate, I'm wondering, I'm going to ask you this in a minute. We won't go there yet." But he was like, "Hey mate, have you got any ideas on how I can increase my borrowing capacity, etc.?" I did have a borrowing capacity of 700,000, so let's assume that was like, I don't know, whatever, 3-6 months ago, whatever the case may be.
Yeah.
I did have a borrowing capacity of 700,000. I now have a borrowing capacity of 350,000. So that's a 50% drop. Now, in his circumstance, he's got a couple of properties that are in a trust. And those trusts completely self-service. And we'll get into. I really want to talk about all of these strategies in a minute. So let's not go there exactly right now.
Yeah.
But he's got a couple of properties in a trust. He's got one property that's in his personal name, which is heavily negatively geared.
Yep.
But his income has stayed the same and everything else has stayed the same. But he's lost 50% of his borrowing capacity.
Yep.
Why might that be?
I guess that 23% borrowing power decrease is multiplied per loan that you've actually got. So, if you were paying 3.5% on one of your interest, on one of your loans, one of your investment loans, you're paying now around sort of 5.5 or 6%. So you've got multiple properties. That decrease is almost compounded. Other than that, I mean, without looking at their situation, we're not going to go down the rabbit hole just yet around trust lending and isolating, those more advanced strategies. But that would be it, I would say, because that client has multiple properties, that sort of compound effect across their entire portfolio is decreased. The other thing to keep in mind as well, and we can sort of discuss it sort of later today or right now, is pre-approvals. Every bank does it differently. And this is where you really need a broker just to sort of know what's going on. And what I mean by that, we've got lenders, if you've been pre-approved, say in August, they will actually honour that assessment rate at that particular time. So the interest rates may have been 4%, where now they're actually 5%. So that particular bank will honour that assessment rate during that pre-approval period, which is normally 90 days. A lot of banks aren't actually adopting that philosophy. So they're looking at it, Mr. Client, even though we've pre-approved you, when you actually find a property, we're going to assess you on today's interest rate. So your point at the beginning, mate, where you mentioned before that clients are struggling, they've been pre-approved, they found a property, hang on, they don't actually service anymore. It's knowing which lenders are actually going to honour that pre-approval. That's part of the strategy as well.
Are you able to, I don't want to drop you in any hot water, but are you able to say like what lenders are doing that? Because I've seen that to be quite a big problem. Because as you were saying that, I was like, hang on a second, because we're like, obviously we help people to buy properties, right? And so we're helping people to do that in 90 days. Like within that period, they're finding a property and then all of a sudden it's like, whoops, can't get any money. So like if someone's working with you, great. But if it doesn't matter who they're working with, like how can they kind of know? Because like having a pre-approval is going to give people confidence to go, yes, I'm going to go do this. And like, let's be honest, the emotional setback, the financial frustration, sure. Like, damn, I thought I was going to buy that property. That's annoying, whatever. But also the emotional frustration, you go on this journey, you're like, okay, I'm going to buy a property. That's a big emotional hurdle to get over. You then go and get a pre-approval. You're like, I'm on the home straight and I've got the team and I'm doing the thing and I get the stuff. And then at last minute, you get kicked in the guts and you're told, no, go home. That's pretty demoralizing for people. That can really make people go, that can really make people just basically go, fuck this. I'm out. This is too annoying and it's stacked against me. But if people, how can people know it? Are you able to shed any light on that? Who is going to like trip them up at the last hurdle and who isn't?
Yeah, for sure. I mean, the big thing is you need to be asking your bank or broker, is this loan, or is this pre-approval fully assessed? Is this a fully assessed pre-approval? Or is it an actual computer spits out a decision inside of 5 minutes saying you're pre-approved, but actually hasn't been assessed? That's one question to ask. Now, not all banks do that. Commonwealth Bank, as an example, do a full assessment. Bank West, who Commonwealth Bank own, don't do a full assessment. That's just an example. And the little variances between different lenders and, banks that own other banks as well. We've got a couple of second tiers that'll do a full assessment. We've got other second tiers that don't. The other thing I want to highlight as well, Goose, let's assume Commonwealth Bank fully assesses you. So they, back in July, back in August, interest rates are 4%, 3.5%. Goose, you've been approved for 500,000. Let's say the LVR was 80%. Let's say the loan amount was 500,000. If we then come back to Commonwealth Bank and say, all right, the client's found a property, but we want to take the LVR up from 80% to say 88 or 90% now, that's classified as a material change. So CBA won't honour that pre-approval. They'll actually say, well, hey, you're making a material change to the actual loan. We're going to assess you on today's rate. So I guess two things there. Ask your broker, ask the bank, is this loan fully assessed? Is it valid for 90 days? And the important part there is to actually make sure your loan's correct from the start. So not just, hey, let's just get it in, we'll worry about that later. Is it set up correctly? Is it set up in interest only? Is it set up at 80%? Is it set up 88%? Is it set up under a trust or personal name? Because if you're making a change after the pre-approval's issued, that bank is going to assess you on today's rates.
Yeah. And so for the benefit of people listening as well, like, can we talk about the difference between a borrowing capacity assessment and a pre-approval, right? Because I know that people are going to brokers and
Yep.
going, hey, can I get a borrowing capacity assessment? And they're going, yeah, Yahoo, 1.2 million, off you go. How is that different? And to your point, like maybe that's not factoring in like, okay, specifically what is the right loan structure? Like what are you specifically going to get to? Because what I
Yep.
feel, so again, just to reiterate my point, property wise, the market is
Yep.
sweet. Like if you can buy right now, it's probably the best time that it's like, it's literally, it's,
1,000%.
oh my
Yeah.
God, it's like,
We'll cover that off
it's
probably
just, yeah.
shortly, a couple of points there.
Yeah,
But
it's a stupidly good time to be buying property right now if you can buy property. And I think where people are getting stuck is they're going, right, cool. I'm going to get my ducks in a row. I'll get a borrowing capacity assessment done. And the borrowing capacity assessment done might be 1.2 million. But then, like psychologically, they're going to start feeling like someone's lying to them. Like, can you talk about the difference between those two things?
yeah, I guess you need to, again, ask your broker, like us, me, as an example.
Mm,
When we run a borrowing capacity, it's normally we're running it with the lenders that offer the highest borrowing capacity. Now, what I mean by that is, we're looking at a lot of these second tier lenders. It doesn't necessarily mean we're going to take you there straight away. So, Mr. Client or Goose, hey, your borrowing capacity is 1.2 million with one of our investor-friendly lenders. But the strategy to start with is to fill your boots with these major type lenders where you don't actually have that higher borrowing power. So that's part
okay.
one. So, all right, we use CBA. CBA offers you 800,000. That's all you can borrow. Friendly lender offers you 1.2 million. So we're saying, all right, maximum borrowing capacity potentially 1.2 million. The other thing is time is of an essence in the current market. Like we're speaking to clients that we spoke to, 30 days, 60 days, running an assessment, you can borrow 500,000 to the client. The time they actually say, all right, I'm committed, I'm all in, let's go, pre-approval, here's the documents. We're 6 to 8 weeks down the chain. There's been 2 or 3 rate increases since then. So that
Yeah.
500,000 then diminishes down to maybe 450 as an example as well. So they're probably the two key drivers, just knowing how the borrowing capacity has been run and who with.
Yeah.
Where am I going for my initial sort of portfolio? And then also just when did I actually speak to the broker or the banker?
Yeah. Okay.
Because
This is
it's
really interesting.
moving.
This is really interesting. So a couple of things. So if you're going to get if you're going to get a pre-approval, make sure it's a fully assessed pre-approval, right?
Correct.
Not
Yep.
just
Computer says yes.
computer says yes. But then also, if you're going to ask your broker for your borrowing capacity assessment, what you should actually be asking is, can you work out based on like basically do a pre-approval, almost do a pre-approval, right? Because just saying, hey, in the spectrum of 438 potential lenders in Australia who might theoretically potentially give me the highest possible number of borrowing capacity. I mean, that's kind of like, that's basically you're just asking for a whimsical kind of number, which could actually set you up for failure, not success. Nice to know, but also what you actually want is reality. I always say it's easy to paint a pretty picture, but it's much better to paint a realistic one. So, so making sure that you're asking that and shortening the time, but time to action. So how can people better prepare? Like if you've got people, so let's say someone's going to their broker, and again, they could be working with you, they could be working with their own broker. It doesn't matter. But if they're like, okay, I want to get in the game, it's all good, right? Rather than just ringing up and going, hey, how much can I borrow? Yeah, my income's this, and then waiting to get the number, and then getting excited, and then taking 6 to 8 weeks to sort their shit out, and then having all this kind of stuff. Before they start, what should they have ready? Like, what are the kind of just a couple of tick boxes they should have their stuff together so that they can go, hey, by the way, I want to know what is my actual borrowing capacity if I wanted to borrow on a 90% LVR, and if I wanted to buy a property tomorrow, what do they need to be able to move that forward?
I guess it's a mindset thing to start with. Like, are you actually committed? Are you just dipping your toe in the water to see, where I am at the moment? Or are you actually committed? Because like you said before, I think this next period before rates start to potentially come down next year, you've got if you've got the means to access equity, you've got pre-approval or borrowing power, now is the time to obviously set yourself up. So get your ducks in a row, pull out your equity, get your pre-approvals, your fully assessed pre-approvals, and actually take action now. And I think the biggest thing is just speak to your broker or banker and say, hey, I'm ready to move forward. I want to highlight to most clients, most brokers don't charge fees. Most bankers don't charge fees. A pre-approval costs you nothing. If a pre-approval lapses, I mean, it's not ideal for our business model, but if a pre-approval lapses, I'm not going to say, hey, Goose, here's $100 invoice. You owe us money. We can easily get that extended. So it's a mindset thing. Am I actually committed to doing something now? Am I actually committed to actually getting market ready now? And if I am, let's push go straight away. Most of our applications, as an example, are online. You spend half an hour on a weekend, you can have everything back to us. We can have something to you within 1 or 2 days. We're underway. We're submitted to the bank. So that's probably the key thing. The other point I wanted to highlight quickly as well, Goose, is I often say to our clients, it's actually easier. I know we can just say, lender A is going to offer you $3 million, Mr. Client. I often say to our clients, it's actually easier to get the new lending than it often is to actually get the equity out from your current bank. We've got a lot of clients that are fixed. They're on good rates with your first tiers, your Commonwealths, your NABs, your CBAs. Their borrowing capacity is only so much. We can't move them, or there's no financial benefit in moving that loan. And it's actually harder because their borrowing power is smaller than me, just to pull out equity from that, where Mr. Client, I can get you another 400,000 or 500,000 with, that investor-friendly lender. So it's a bit of a strange one for clients to understand. But yeah, that's often the challenge as well. But I just say, yeah, if you're committed, let's pull the trigger now, because if you're delaying it, kicking the stone down the road and saying, hey, I'm not sure I want to actually do this. Interest rates are moving. Your borrowing power is decreasing with each RBA increase.
Well, that's a good next point. How much does a 0.25% interest rate rise reduce borrowing capacity?
Yeah, 2.5. Did a little bit of modeling as well. Like I mentioned before, 2.5. It's almost sort of 2 to 2.5%, roughly. It just depends on the client's circumstance. Single, dual income, one property.
But as a heuristic for people to be thinking about, if I can borrow $1 million today, and then the interest rate, so as we record this, we're late in October. By the time it's coming out, there'll be another probably rate rise. If I can borrow $1 million right now, and then the cash rate goes up by another 2.5%. How much do you reckon that would affect or drop the borrowing capacity? Just roughly. Yeah. I'm not going to pin into this. 2.5%.
Roughly. Yeah.
Interesting. So 10 times the cash rate rise.
Yeah, on average.
That's interesting.
Yeah. As I said before, that example, Mr. or Mrs. Client, $100,000, no debts. Their borrowing power, obviously the cash rate's gone from 0.1 to 2, I think 2.6 we're sitting at the moment.
Yep.
Their borrowing power is decreased by around 24 to 25%. But just on average, you're sitting in your lounge room, you see the RBA announce another 0.25%, roughly 2.5% of your borrowing power. Prior to last month, the RBA was increasing in 0.5% increments. So you're losing sort of, 5% borrowing power with each increase.
Yeah, interesting.
On average.
Interesting. We're not going to do any interest rate forecasting on this episode because we know how that went last time. Yes. So, but I'd be interested to know, what are some strategies that people can be thinking about to avoid hitting their borrowing capacity limits if they want to be investing in the current environment? Now, there's kind of like this two sides to this question, right? Because there's what can people do right now? Is there anything they can do to increase their borrowing capacity? Is it just as simple as like you need to earn more money and decrease your expenses? Is it that simple? And then the other part of it is like as you invest, what are the investing strategies that people can do? Things like trusts and stuff like that. So let's talk about that. So we'll start on the front side. Is there anything people can do to increase their borrowing capacity in the current environment?
Like you said, earn more money, spend less. Everyone write that on their fridge every morning. You get up and you see that. But no, we've covered this a lot of this previously, Goose. It's the little things to start with. Mr. and Mrs. Client. What is your discretionary spending look like? Is there any additional holidays, TVs? Things you don't need to purchase. That we can cut down on. Keeping in mind the banks normally have a benchmark in terms of living expenses, 2 adults, 2 kids, roughly $4,500, $5,000 a month. If you're going over that spending, and they will review your statements, then they're actually going to adopt the higher figure. So if you're spending $7,000 a month and not $5,000, there's an additional $2,000 a month. Living expenses added onto your, servicing and your borrowing capacity. So that's going to decrease things.
And when they're assessing your statements and stuff, how far back are they going? Are they going back 3 or 6 months when they're looking at your living expenses?
Good question. Depending on the bank. On average, 1 month, but we do have some lenders, ANZ, we'll put them out there, they're 3 months. So again, working with your broker, and we often do, we put plans in place. Hey, Goose, you're spending too much money. This last month, unless we can highlight this is a one-off, you've been to Bali or, you've done a holiday, it's a one-off expense only, unless we can highlight those. But if it's consistent over a number of months, we put clients on a saving plan, get your everyday expenditure in, in order. So that's probably one point just to cover off.
Can I just throw something in there, and you can tell me if I'm
sure.
I might be treading a little bit into the grey here, and I'm not financial advice. Don't take any financial advice from this podcast. Full stop. Right? Just if you're listening to a podcast,
general advice only.
Yeah. If you're listening to a podcast and getting your financial advice from there, you literally need to go and see a professional, maybe not just a financial one, right? So it's not. But could you theoretically, hypothetically, could you just prepay a bunch of your expenses, right? So, for example, could you be like, okay, I want to go get a loan, right? I want to decrease my expenses. I've got all these things I need to pay for. I don't know. It could be like, instead of paying car insurance monthly, maybe I'll pay it annually. Instead of paying rent monthly, maybe I can pay it, I don't know, 6 months ahead. Instead of a gym membership coming out monthly, maybe I could pay that 6 months. And could you potentially get to create a situation where your assessable household income. Now, I don't want to. I'm not breaking any laws or anything here by suggesting this kind of stuff. But I'm just I'm curious.
No. This is stuff you could. I mean, rent's a little bit different. So if you're paying rent, often the banks will ask for a tenancy agreement or something like that. But in terms of expenditure, yes, gym memberships, private health insurance, et cetera, et cetera. I mean, technically, it all has to be disclosed anyway. But if the bank sees all these one-off sports bet, that's a big one. I see that all the time.
I hear so many brokers talking about sports bet. I see
always sports bet as well.
Yeah, everyone loads of brokers have started creating loads of content online. You see it on TikTok and Instagram. They're always talking about sports bet, and I'm just thinking, how many people are on sports bet? I mean, is this that much of a thing? I'm like, I don't gamble. Like, is this a thing?
Yeah, it is. It is. It always seems to be sports bet as well. It doesn't seem to be. You don't see the old tab anymore. But no, that's another thing as well. I mean, you might be. The client might have a couple of $100 withdrawals. They might have a couple of $100 deposits, but it doesn't look good from a bank's perspective. So that's another thing, All right, let's just get rid of it. Stay off the punt for 3 or 4 weeks, and then obviously clear that up. So
probably stay off the punt, like full stop. There's better habits, right? There's better ways to spend your money than just chucking it at the nags.
Property, there's a million things you could be spending that $100 a week type thing on. So yeah, little things like that. We can sort of put a plan or a savings plan in place to give you the best possibility to obviously obtain an approval from the bank. So that's probably step one. The little things, the credit cards, the personal loans, the HEX debts, et cetera, et cetera. Yeah. HEX debt's a big one. Chris, I'm only paying $100 a month, but the way the banks factor it in, they're actually factoring in and forecasting your proposed rental income from your portfolio. So yes, your income might be $100,000, but if your rent of $30,000, they're assessing you and saying, well, you've got $130,000 income. Your percentage of your HEX debt is X, Y, and Z. So if your HEX debt's only a small balance remaining, that's another thing that we say, hey, is there any possibility to clear that? Mm-hmm. Credit cards is a huge one. We've mentioned that before. The banks will take your limit. They do not care if your credit card is cleared monthly, every month. They're going to actually look at the limit. And most banks are using a 3% sort of servicing buffer on that. So they're sort of the main things. Topic of the month is your interest rates. What are your interest rates doing? I mentioned before, most banks have a 3% loading on what you're actually paying when it comes to assessments. You're on 4%, there's 3% on that when they, that's new and existing debts. You're looking at, say, 7%. So what are your interest rates doing? If you've got 4 or 5 loans that are, you're paying 0.5% or 1% higher than the actual market, that's affecting your borrowing power. So can we do something with your existing bank? Can we actually refinance to a new lender? Extend maybe the loan period. You owe 27 years. Let's extend that back over 30 years. That's going to give you more borrowing power. Let's obviously reduce your interest rate. Again, that's obviously going to, give you more borrowing power as well. So they're probably the main things. Particularly looking at your current interest rates. That's really driving a lot of business in our business at the moment.
Cool. Okay. So what about on the other side of the equation? Like, what are some, and these are kind of like more, I guess, maybe advanced strategies and stuff, but can we talk about trust and stuff or any other ideas? Like, how can people macro generally extend their borrowing capacity?
Yep. Yeah. So 2 things just before we go on, I guess, the trust setup, and I guess, borrowing or choosing which entity is the correct, structure for you moving forward. Lender selection's a big one as well. And what I mean by that, we've got lenders majority of major banks, I'll take 80% of rental income. So if you're earning $100,000 in rental income, they'll only take 80,000 of that. It's a very black and white rule.
Yep.
If you're doing overtime, unless you're in a, police, ambulance, et cetera, they're going to shade it by 20% as well. So lender selection, we've got certain lenders, again, that will take 100% of overtime. They'll take 100% of, negative gearing. They'll take 100% of rental income received. So little things like that as well. That could be the difference between an extra 300,000 or 400,000 borrowing power, particularly if you've got a multi-property portfolio in comparison to the majors or the first-tier type lenders saying no. You're basically at your limit already. So that's one thing. You mentioned before, Goose, trust. Buying inside of a trust, that is a strategy. Disclaimer again, I can't give tax advice, and we always advise our clients, and we do, and I have this conversation daily, especially with our more advanced clients and clients now in the current environment that are actually reaching their borrowing capacity limit in their personal names. Seek the advice of your accountant. There's pros and cons for setting up a trust and not setting up a trust, but from a lending perspective, we do have some lenders. We've got about 4 or 5 on our panel out of sort of 45 banks that can isolate and exclude that trust debt in the future if that property is basically washing its own face and, it's not running at a loss. So if you buy, let's say, investment property in WA, it's neutral to positively geared, 12 months time, 6 months time, we get a letter from your accountant saying, it's not running at a loss, it's basically running profitable. That bank can actually exclude that debt, and they won't include the rental income. But I mean, that's an extra potential 300,000 or 400,000 if that's what your lending is inside the trust of borrowing power that we now free up. And that's a strategy that not many bankers can do that. But that's a strategy not many brokers, unless you're playing in the investment space, are aware of. And I can put my hand up and say, even many of Dashlot's clients, we've used this strategy. Their borrowing power, I look and say, Goose, you've got one more property in you. Basically on your income as of today, unless something changes, you've got one more property in you. So do we look at a different structure for the next one? So then after that next one, we can come back and say, let's try and isolate that trust debt, and then that allows you to go again. So that's a big one.
Yeah, I think that's a really big one for people to consider. And again, massive caveat: neither Chris nor I are licensed or anything to talk about trusts and tax structures and setups and stuff like that. So you have to speak to an accountant about this kind of stuff. But the thesis around how this works is pretty solid, because it does. We've seen it actually work. We've actually seen it play out for multiple clients. The caveat being, you need the trust to be able to self-service, which means it needs to be able to wash its own face or produce enough income to cover all of its costs and expenses, all that kind of stuff. Like having a negatively geared property in a trust is probably not a good idea. But again, that's a tax kind of question that you would speak to your accountant about, etc. But obviously a good way of doing that is obviously put your loans on interest only, right? And that's going to then obviously help the cash flow position in your trust. And, there's a few things you can kind of do around that to help create a situation where that is going to be the reality. And I think that is, again, caveat, don't take our advice from this, but I think that is something that people should be really considering as they are operating in this current environment. It's kind of like, okay, cool. So borrowing capacity is being diminished. What do I need to do to safeguard and shield myself from that? Yeah, okay, decrease expenses, increase income if possible, which is easier said than done. But also think about what is the optimal structure to make sure that I'm not going to run into limits. And there's trade-offs with interest only and principal and interest. And sometimes you can get higher borrowing capacities with principal and interest. And there's a few trade-offs there. So it's not as clear cut as just like do this, tick a box, done, bang. But there are ways that people can explore to be able to continue to navigate that. Speaking of principal and interest only, what do you think is the right strategy in this environment? Should people be going interest only because interest rates are going up and therefore protect their downside on potential negative cash flow? Or should people be going principal and interest to pay down more of their debt faster?
Investment lending, I would always go interest only to start with. Various reasons. I mean, there's tax advantages, cash flow. People say, Chris, it's a mindset thing. I want to pay down the loan. But yeah, I guess people don't understand, especially in a higher interest rate environment as well. It's all about looking at your cash flow as well, and you're sort of maximizing your deductions. And, what are your future goals, Mr. Client? Are you looking to buy a house to actually live in? If that's a future goal, it mightn't be now, but if that's a future goal, which most people want to buy a house, they want to actually live somewhere, then yeah, definitely you want interest only. I reckon 98% of our clients are interest only. If you've got an owner occupied home at the moment, a little bit different. So I do see clients more advanced clients that do obviously have the interest only set up on owner occupier, they've got to use it correctly, use the offset account, all your money, all your rental income, basically all your expenditures coming from the credit card, sweep it monthly. But for traditional investors, your mum and dad type people, a lot of people on this podcast, if you've got an owner occupied property, you want that loan only on principal and interest. You're going to pay one debt down. That is the debt to pay down. I see this all the time, Chris. I've got the owner occupier, I've got the investor one, I've got the investor two, the investor three. They're all on P&I. I want to pay them all down now. It's got to be paid down, and that's, again, it's about maximizing your money in the best possible way, because there's good debt and bad debt. We may have.
Yeah, there's actually, we did a whole episode on it recently called Should I Pay Down My Debt? And it's actually one of our most listened to episodes. And if you're listening to this and you haven't, and you want to dig into that specific topic a little bit further, we go really, really, really deep on that specifically. You mentioned about, just a little side note, you mentioned about most people want to buy a home. Now, I don't know, maybe I'm a little different.
Not all people. It's changing. The landscape is changing.
It's totally changing.
Yeah. It's not the mum and dad, buy your home, pay it down 30 years, have no assets when you're 50 or 60. It's not that. Yeah, but some people do have aspirations, along with investing, to buy their home. Not all people, and you're probably one of them.
Yeah, it's really interesting because, I think everyone has this dream of buying a home. Even I like to dream big, right? And so, I'll be looking up, I'll be honest, I found this beautiful cliff-top mansion in Uluwatu, and I was looking, I was like, oh yeah, I want to buy that house. And it's a fraction of the cost of what you would, it's probably the equivalent of what you might spend on some shitty townhouse in Sydney. It's is the cost, right? But I was like, oh, that looks awesome. And that looks beautiful. Yeah, pretty much, right? But I was kind of if someone just gave me all the money to buy that, right? Yeah, don't get me wrong, it's a few million bucks, right? I was like, if someone just gave me all the money to buy that, would I actually go and buy that property? Even though I'm looking at it and going, oh, I think that's my dream house. And everyone has that. I think it's good to visualize, right? So I use it as a visualization tool. And I'm like, ooh. I'm like, would I actually go and do that? And I'm like, well, I could take that few $1 million, invest it, create cash flow, and then just use the cash flow to go and rent somewhere. It might not be that exact place, but I can just go rent somewhere else and that compound. Yeah. And it just continues. Every time I think about that dream of buying a house, I just go, well, if that money was somewhere else, I could just, I mean, even rents will go up. That's fine. But so will I'm just there's the emotional side, which says, let's go buy a house. And then there's the logical side, which is I can't see a scenario that makes sense. It just doesn't map to me.
Correct. Yeah. And it does depend on your circumstances. I mean, if you want to create wealth through property investing, absolutely. But if you're living in Sydney or Melbourne and you're going to drop up, 1 or 1.5 million on a place to live, most clients, that blows your borrowing capacity out of the water. Yeah. So, but we're seeing, and I'm sure you've done an episode, rent vesting. Absolutely. We're seeing more and more clients. I actually did that myself. I rent vested for 10 years, built a multi-property portfolio. The wife came along and she had other ideas. So we do have the home as well. But structure-wise for us, P&I only on that, all our rental incomes, all our salaries, everything going into that owner-occupied offset account, and all my investment debt is all on interest only. The other point I just want to quickly touch before we move on is, if you have an owner-occupied home, but you've got goals again, hey, Chris, I want to upgrade our property in the next 2 or 3 years, do not be paying that down. Do not be paying that principal down, because that property will eventually turn into an investment property. This is another sort of strategy that we see that's, clients aren't doing the right thing. It's the old mindset, I want to pay it down. That debt is going to be an investment debt at some stage in the future. So the ideal structure for you listening on this podcast, if you've got aspirations, you've got a home already and you want to upgrade in the future, rightly or wrongly, that should be set up on an interest-only basis, and you should be channeling all your money into the offset. That money in the offset can then go to your dream home to pay down that bad debt, or have a big chunky deposit on that bad debt in the future. So that's one I see 8 or 9 times out of 10 that the clients just aren't, they don't have the right structure for that. So
yeah, that's an interesting one. I always say the same thing. I'm like, is it your dream home? Even if let's say you own a house now, or let's say you want to buy a house now, to live in, buy a home now. The question is it your dream home? Because unless it is going to be your this is my dream forever home, or at least forever for 20, 30, 40 years, going to unless it's the one, then you should be treating it like a transient asset, either like a potential investment property, or as a transient way for you to be just doing something other than just renting, if that for whatever reason made more sense to you. But the other thing on that as well is that, emotions are real. It's all well and good to be like, hey, look, and I had a conversation with a client the other night who was like, hey, I currently own the house that I live in. We're trying to decide, do we invest? Should we invest, or should we like buy a nicer house? And I was like, well, kind of depends, right? Like if you're asking me what's the best financial decision, I'm like, well, investing. I said, but it totally depends. If you've got a kid on the way, for example, you're in super nesting mode and you're like, right, I've just got to, emotions are real and you got to live that too. So you're just going to make whatever's the right decision for that. But that's not, there's so much more I want to tackle, right? So,
yes,
okay.
Yep.
So basically you're saying interest only makes the most amount of sense generally, right?
Generally, across the board. Offset account as well. Definitely want an offset account, whether it's just an investment loan or you don't have an owner occupier. You want offset account at least. A lot of people have the.
If someone doesn't have an
products,
someone doesn't have an offset account, let's say they've got 3 or 4 loans and for whatever reason they don't have an offset account, what do they do?
Well, where is your money going? So like is it, for those that don't know, an offset account, it offsets interest. $1 million loan, you got 100,000 in the offset, you're paying interest on 900,000, not $1 million. And it's actually calculated daily, even though your repayment comes out monthly. So even if you got $1,000 or $10,000, that little amount each month, compounded over a year, compounded over 5 or 10 years, is saving you, 20, 30, 50, 60,000 in interest, and you can save yourself 2, 3, 5 years off your mortgage. So it's again structuring your loans right, making sure you're using things like offset accounts as well. So
yeah, okay, cool.
Yep.
Should people, because interest rates may continue to go up, probably going to continue to go up for a little while. I have opinions on this, but again, we'll stay away from forecasting in this episode. But should
I've got opinions as well. Yeah, we'll leave that for we'll leave that for another episode.
Yeah, totally. Should people be fixing their rates, or should they be keeping them variable? Because I know that fixed rates have actually come down a little bit, haven't they?
They have, yeah. We're still advising our clients, if you can. I won't get any interest rates, but we're thinking. The commentary is we're thinking we're nearing the end of the rate cycle. Yes, maybe no. Our recommendation for the majority of clients is still variable. You're looking 1 year fixed rates are at least 0.5% higher, which isn't much. So they are coming down, but 2 year fixed, you're looking at least 1%. Beyond 2 years, you're looking sort of 1.5% difference between variable and fixed. So now is not the time. I've seen this play out before, about 8, 9, 10 years ago, I think 2011, 2012, where clients panic. They fix in at 7.5%. Interest rates start to come back down. They're 3.5% on the variable side. Chris, I've got a 7.5% fixed rate. It's going to cost you like $10,000, $20,000 to actually exit that fixed rate. So if you can, in the current environment, ride out the wave. I think, we're starting to see a little bit of light on the horizon. In variable, in our opinion, for the majority of clients, is what we're recommending for both investment and also owner occupied as well. You also have more flexibility with variable as well, with offset accounts. You can pay down debt if you want to pay down debt, or certain other things as well. So I think ride the wave. Variable is what we're recommending for most clients.
Okay, yeah, because it's a bit of a tricky one, right? Because variable means that, well, it is variable. So if interest rates keep going up, then your interest rate might keep going up. But then if interest rates come down, your interest rate will come down, right? So there's that. You've got to be ready to surf the wave. But there's also macro benefits. It's easier to refinance. It's you can, and Gabby and I transparently made that mistake early on. We really had no idea what we were doing, and we bought a property, and the broker was like, "Oh, hey, fix the rates." And we fixed the rates, and they were like, I think, close to 6%. We'll say. It was not a nice loan. It was not a good one. And then it was
panicked.
Well, we didn't know what we were doing, so we actually it wasn't even a case of panicking. We just said, "What do we do?" And he said, "Just do this," and we just said, "Okay, okay, let's do that." Right? This is pretty early on. And then we started Dashdot, which meant that we couldn't actually, we had started the business. We couldn't actually go and refinance the loan. So for like 2 years, we were stuck with this gross loan that was just it was so painful. And to break it, I think we worked out at one point we could, but to break it was going to cost $5,000 to break the loan. And it was like to try and refinance it.
Big amount.
It was like the $5,000 that we would have had to pay as a break fee was going to negate any potential gain we might have had by refinancing it to another loan. And so we just had to, it was a real thorn in our side for a real long period of time. So,
and we're seeing that. Like I'm finding it, like clients are fixed, and admittedly they're on a good fixed rate, but I can't get you any more lending with that bank, with that major bank. Yeah, hamstrung. You've got borrowing power, but we can't move you. So it's like you said, it allows you to refinance. Also, valuations is the big one. We may have touched on it before. Let's say your bank, we use ANZ, comes back at 500, CBA comes back at 600, but you fixed at ANZ. You've got equity in the property with a different bank, but because you're fixed, we can't readily move your loan to a different bank. You're stuck. You've got borrowing power, but we can't access that equity. So most clients, as I said, ride the wave. Don't panic now. I know there's a lot of sort of fear. Don't read the Daily Telegraph and these online lenders, newspapers, I should say. Variable, ride it out. Hopefully rates start to come back down in the next 12, 18, 24 months. And then there's going to be some good fixed rates in the market. So then we'll start looking at that again.
Speaking of valuations, obviously you get valuations done, refinance. Have you, in your line of work, have you seen valuations coming down? Like, have you actually seen it generally that property market values are going down, or is it in isolated areas? Can you give us some insight from that? Because you're looking at valuations probably daily, probably hundreds a week. So you'd be
50 or 60 a week at minimum. There you go. As a team. I mean, answer your question is no across the board. Now it does depend in isolated sort of areas. Sydney may be a little bit established home. Eastern suburbs there may have been a 10 or 15% reduction, but we work the majority of times with investors. So our clients are buying in Queensland. Like one of my brokers, we had a laugh the other day. Even these old, I call them shit boxes. Excuse the language,
mate. Nothing wrong with the shit box.
Yeah, we had clients buying in Queensland, and they were not through you guys. 2 or 3 years ago, you'd look at them going, "Wow," they were struggling to stack up on a valuation sense at that time when it came time to completion. 200,000-300,000 higher now in the current market. I've even got clients that have bought off the plan, 12 months ago, a little bit concerned around those type of properties. Traditionally, they're the properties that come in under market value. Sign a contract 12 months ago for 500,000. Comes time for settlement, it's only worth 450. Majority of times, they're coming in at contract price as well. So in the current environment, the doom and gloom, house prices crashing, all this stuff you see online, even these off the plan properties are stacking up to what clients purchased them for prior. So I guess to generalize it and answer your question there, mate, no, not seeing it. Areas, Queensland, even WA now, like we're seeing clients getting 20, 30, 40 grand growth from 6 to 12 months ago in WA now. So it's picking a market, but across the board, they're stacking up well.
Yeah, cool. That's interesting. That's super interesting because it goes completely against the narrative that we keep getting fed, and it also is in line with everything that we see as well, which is really interesting as well. Can we talk about LVRs for a second? Because obviously, hey, if you can get, it's great to be able to enter into the market on a, let's say a 5% deposit if you can get a 95% LVR or something like that. I saw
they're coming back for owner occupieds only. So there's a lot of incentives. There are a lot of incentives tailored around your owner occupied market. But yeah,
it's interesting. Yeah. I saw a guy that I know, and he's a great guy, and I'm not going to try and say anything negative about him, but he buys multi-million-dollar properties in Sydney for investors, and he was talking about buying with 5% deposits, and I'm like, the yields. So I'm like, just the thought of like that debt obligation, like that negatively, I was just like, far out. Like that seems intense to me. So how should people be thinking in this environment about LVRs? Like, should they, because like kind of a more typical one for investors that we would often talk about is like a 90% LVR for investors, kind of like a typically good in inverted commas, good for someone, maybe not you, get your own advice, all of that stuff would be like 90% LVR or 88% LVR with NMI, LMI or whatever, on an interest-only basis. That'll kind of optimize your efficiency of return and all of that kind of stuff. In the current environment with higher interest rates, do you think that still is a good combo of like interest only? We've kind of covered that, but do you think 90% is still the way to go? Should people be trying to invest with lower LVRs, or in fact, should they be going for 90% LVR, but then if they've got any surplus cash, whacking it in the offset? Or, can we kind of talk about that a little bit? Because I think this is a really interesting thing to think about in the current environment.
Yeah. Good question. I guess good debt, bad debt. We're focused on investors here, but I guess bad debt, your owner occupier, if you've got one, ideally you want to be putting as much deposit in as possible. You can't claim any tax
Mm.
deductions on your owner occupied property. But, as I said, we work with all people, but yeah, probably 80% or 70% of our books working with investors and a lot of your clients as well, Goose. So traditionally, we would gear our clients up to say an 88 or 90% LVR. So LVR being loan to value ratio. So couple of reasons for that. We want to minimize the capital outlay
Mm.
for each purchase. If you've got aspirations to buy multiple investment properties, a 20% deposit in comparison to a 12 or a 10% deposit is obviously less. I get the question, the pushback, Chris, but I've got to pay mortgage insurance. As an investor, look at mortgage insurance as a tool or a vehicle that's going to help you create wealth. So that's allowing you to minimize that deposit. Can't give tax advice again, but the mortgage insurance premium, it's not an out-of-pocket expense as such. It's added to the loan. So you're not actually physically paying from your savings. And it is tax deductible. We'll get your tax advice again. But it is tax deductible over a 5-year period. So if it's $10,000 added on your loan, you can claim that over a 5-year period. So traditionally, yeah, we would try and gear it up as much as possible. I mean, if a client's got $500,000, maybe we look at that client and say, hey, let's set this one at 80%. Nothing
Mm.
stopping us from taking that above 80% and pulling out equity in the future. I've got a prime. Sorry, I know you
I,
didn't talk.
yeah, go on. You
I
keep
was just
going.
going to say, I've just got a prime example now. I've got clients on that we're working with at the moment. $500,000, Chris, we want to invest. We're looking at, do you need to obviously minimize that deposit? And they say, Chris, we want 3 properties, in the next 6 months. So rather than 3 times 20% deposits,
Mm.
these clients, good cash position behind them, but we've decided and they've agreed that let's minimize each deposit because you've got a strategy of buying multi-property portfolio. So traditionally, interest only, gear it up to sort of 88, 90% for investors. That's, I reckon, 80 to 90% of our clients are, on that sort of LVR
Yeah,
range.
yeah, it's pretty interesting, right? Because even if someone's got $1 million in cash, right, and they want to
Yep.
go and invest, I would argue that it is smarter to do a 90. We'll say 90% just for the simplicity of it. It's 88%, including LMI and whatever. So it's a really good point, actually, that you pointed out there that LMI isn't a cash expense; it's capitalized into the loan. Because a lot of people
Correct.
think, oh, I'm going to get this loan, and then I've got this whatever 3, 5, whatever the amount of $1,000, I've got to pay that. It's like, no, you don't need to pay that, right? Like
Yep.
it goes into the loan, and the tenants pay your LMI. Like you don't
Yep.
pay the LMI as long as you.
Correct.
It's crazy.
As I said,
But
it's a vehicle, it's a tool, it's going to help you.
totally. And like you just got to. People don't think about the return. They look at the cost and they don't look at the return. And it's like, okay, that the cost of the LMI versus what that will get you in additional borrowing power. Magnify. Anyway, we're not talking about LMI, but if someone's got $1 million in cash, I would argue strategically that it would be a better solution to go 90% LVR and then put all of the excess cash into the offset so that they have the liquidity opportunity, right? Because they're still going to be in effect reducing their debt, right? So they can effectively manufacture their own LVR
Yep.
by contributions to their offset account, and also still have the opportunity to just have complete liquidity of that capital if they want to go and do something else without having to go through a refinance or without having to go through the rigmarole of like, oh, can I take more equity out? Can I refinance the property? Can I do all of that? Can I get an assessment? So I would argue, like, particularly in the current environment, like
Yep.
that you're actually better to just whatever you got, stick it in an offset, but also use that as a tool. You might have $1 million in cash, and then you go and use a $200,000 deposit to go and buy $1 million house, but then go and put the other $800,000, $200,000 to buy $2 million. Anyway, you get the idea. But just chuck all the cash in the offset, and use that as that kind of like as a parking vehicle.
Yeah. That's the advantage of an offset as well with interest only repayment. So yeah, $500,000, 300 in the offset, you're paying interest on 200,000. So yeah, I guess for the listeners, Goose is saying, rather than putting in 100,000 deposit plus stamps on a 500 purchase, you're putting in a 50,000 deposit plus stamps, but you're parking that extra savings in the offset. So you're still only paying interest on 300,000 as an example. And you've got liquidity there. So if you see another property, you can pull 50 out straight away. So you're not tied up rather than us having to go back to the bank and say, hey, can you release more funds, et cetera, et cetera. So yeah, as I said, most of our clients traditionally, and in the current day, we would sort of gear them up to sort of that 88 or 90%.
Yeah, awesome, awesome. Okay, cool. I don't want this episode to run too much longer because people will
Yep.
tune out and won't listen, right? But
Yep.
a couple of things I want to, a couple of things I want to tick off, right?
We could
So,
talk all day, really.
yeah, I know we could. I was just thinking that I was like, I was looking at the time and I was like, man, we could keep going for probably an hour and a half, another 2 hours or something. I go talking about this. It's a really good topic, and it's really interesting in the current environment. So a couple of things, I just want to recap on a couple of things.
Yep.
So when people are getting a pre-approval, to make sure that they're not accidentally going to basically get tripped up at the last hurdle, make sure that it is a fully assessed pre-approval, and then make sure that they're buying within that 90-day window, right?
And make sure your structure's right when you submit, or your broker submits that pre-approval.
So you don't have to go and redo the pre-approval, right?
Then it gets reassessed as of today's rates. Yep.
Good. That's a good clarification. So make sure that you get it. If you're going to get a pre-approval, make sure it's a fully assessed pre-approval, not just a bank a robot spit out, and make sure it is in the right name and also to the right specifications of the loan that you want. So, for example, is it a pre-approval for you personally, or is it a pre-approval for your that you're going to purchase in your trust? Is it is a pre-approval at 80%, or is it a pre-approval at 90%? Is it a pre-approval on P&I? Is it a pre-approval on interest only? Because if you change any of the detail at the last minute, you'll have to start again, and then you could end up in a situation you don't want to be in. Okay.
Correct. Yep.
So that's good. Increasing your borrowing capacity is basically either decrease your expenses or increase your income. Pretty much, right? Ta-da! It's not magic, but they're the levers that you can think about pulling, and there's some creative ways people might be able to think about doing that as well. If you're investing, if you're investing in the current environment, it might be a really good opportunity to consider using trusts as an opportunity to maximize your potential to be able to continue to borrow by isolating debt and doing all of that kind of stuff. Again, get tax advice. It's not who we are and what we do, but it's a really good thing that you should be considering if you're a sophisticated investor and you want to continue to grow your portfolio.
Yep.
Offsets, I think this is a big takeaway. Offsets could be the key here, right?
Yep.
Because you can park any and all of your additional savings rather than having any savings in your bank account, rather than pumping your money on sports bet. You'll get a better return. You will get a better return taking all of that sports bet cash and putting it in your offset than you will gambling. I don't know the facts about that, but I'm going to say that's pretty likely to be true because every dollar that you're putting in your offset, you're literally getting whatever your interest rate is. You're making that return on your cash. So if your interest rate's 5%, you're making 5% on your money. That's bloody good. Better than in the savings account, right?
Yeah, it is. It is. Yeah, we won't. Yeah, it is. Yeah, your home loan interest rate is normally, it should be higher than your cash savings account as well. I get that question all the time, but I'm saying 2.5%. Your home loan rate's 5.5%. So the actual benefit, you're maximising the benefit by having it in your home loan account rather than earning 2.5% interest each month. So
it's better than shares. Not funny. We've said that enough times, but it's pretty much one of the best investments you can make at the moment because you know what the return is. You know that if your interest rate, if your home loan interest rate, or your mortgage interest rate is 5%, chuck your money in the offset, you're making that on your cash. Like it's a pretty good way to maximise. It's an the way I think about it is an investment, because once all this stuff started happening, I just went, let's take all of our cash and chuck it into the offset. All good.
Yeah.
And
I know we're short of time. If you're pulling out equity as well, throw it in the offset. So, I mean, that's tax-free income. You're not getting charged interest on it, but that's tax-free income. There's $100,000 putting in the offset and paying an interest on it as well. So there's $100,000 extra that you can put towards your wealth creation.
Which is actually what we're doing right now. So Gabby and I are refinancing, and we're just going to refinance the cash out, whack it in the offset, so that we have the liquidity to be opportunistic if the time comes.
Correct.
So I think we've covered a lot of good ground here around how to navigate this kind of high interest rate environment.
Yep.
Do you have any other advice for investors around how to navigate this environment, or is there anything else you think we missed that specifically relates to how to be successful in the current high interest rate environment?
Yep. Review your home loan interest rates. That's a huge one. Loyalty tax. That's what we call it. I mean, the banks treat their new clients and they do better than they actually do for their existing clients. You could be, I've been with Commonwealth for 10 years. They look after me. I guarantee you they're not reviewing your interest rates. You are paying a higher percentage than, what new to bank business is actually doing as well. That's a huge one at the moment. We're saving clients $2,000, $3,000, $5,000, $10,000 per year. It costs you nothing to refinance. There's a lot of incentives to do that as well. So that's a big one. If you haven't reviewed your interest rates, I'd say in the last 12 months, reach out. We'll have a look. What's available? Can we put you in a better position? So that increases your borrowing power once we lower those interest rate, repayments. So
Awesome.
that's a huge one.
Awesome. Cool, man. Well, I think we've covered a lot of ground on this episode. I think it's actually been really, really valuable. A lot of really good stuff in here where we've kind of like tackled heaps of stuff, everything from like rent vesting through to LMI through to it's just a very, very good episode. So thanks for that. If people want to reach out to you, where do they go?
Chris at unconditionalfinance.com.au, Facebook page, Instagram page. Reach out. So one of the team members, myself, you can book in an appointment with us, and more than happy to chat, whether it's just investment, general chit chat, or whether it's reviewing your portfolio. So please reach out, and let's try and look at your situation leading into Christmas.
Awesome. Cool. Thanks for your time, Chris. Appreciate it.
Thanks, mate. Cheers.